The crypto world is buzzing with excitement as Ripple CEO Brad Garlinghouse reportedly announces a seismic development. The company's XRP escrow releases, which have long been a topic of market speculation and controversy, have officially ended. The final 10 billion XRP tokens have allegedly been distributed directly to major institutional wallets, including names such as Fidelity, Vanguard, and a handful of other strategic financial entities. For years, critics and skeptics have argued that the monthly escrow releases represented potential selling pressure, a latent threat to XRP's price and market stability. But with this final release, the narrative shifts dramatically. Supply is no longer a variable to fear, and the remaining XRP is now firmly in the hands of long-term institutional holders. Market watchers suggest that this could represent one of the most significant supply shocks in the history of cryptocurrency, with the potential to redefine both price dynamics and market perception. The announcement is said to have been made with careful timing and strategic framing. Garlinghouse reportedly emphasized that the escrow program, which previously saw monthly releases of up to 1 billion XRP, is permanently halted. The final batch has been allocated to institutions with a mandate for long-term reserve holdings rather than active market selling. The implications for market psychology are profound. For years, retail and institutional traders have calculated XRP's price trajectory, with the possibility of monthly supply dumping in mind. That risk, a consistent overhang on valuation models, has now been removed. Analysts are already projecting cascading effects. With liquidity tightening and the remaining supply effectively locked away, scarcity-driven price dynamics could trigger massive upward momentum in both the short and long term. The scale of the institutional distribution is equally impactful. With 10 billion XRP moving directly into the wallets of entities such as Fidelity and Vanguard, the market sees an unprecedented concentration of ownership. This is not mere accumulation, it is a structural reconfiguration of supply. Institutions now hold the power to define market dynamics through long-term reserve management rather than speculative selling. Insiders suggest that these institutions have been strategically selected for their ability to steward the asset, ensuring that it functions as a foundational component of their treasury and investment strategies rather than a transactional commodity. The psychological effect on retail investors is immediate. The narrative of sell pressure evaporates overnight, replaced by a story of permanence, institutional trust, and scarcity-driven value creation. Market reactions are swift. Trading platforms, exchanges, and social media channels report sudden spikes in activity as investors react to the confirmation that the remaining supply is no longer a threat to price stability. Analysts note that with the escrow halted, XRP is entering a new phase, new curve per escrow, new the era of institutional lockup. Each price movement now carries new significance, reflecting demand dynamics unencumbered by predictable monthly supply. The implications for market modeling are immense. Volatility may initially spike as participants digest the news, but the long-term effect could be a sustained upward trajectory fueled by scarcity, confidence, and institutional backing. The shift from perceived risk to confirmed supply constraint represents a paradigm change for both speculative traders and strategic investors. Beyond the immediate market implications, the escrow cessation reshapes broader narratives in the crypto ecosystem. For years, XRP has been criticized for the potential centralization of supply, with skeptics arguing that Ripple's control over escrow releases could be weaponized to manipulate markets. By ending the program and distributing the final tranche to established institutional holders, Ripple effectively neutralizes these criticisms. The message is clear. XRP is no longer a token subject to predictable company-driven market intervention. Instead, it is positioned as a long-term institutionally backed digital asset whose supply is finite, predictable, and strategically managed. Analysts argue that this marks the transition from speculative crypto to a mature financial instrument, with supply certainty as the cornerstone of valuation and investor confidence. The narrative of institutional adoption gains additional momentum as reports detail the identities of some receiving wallets. Fidelity, Vanguard, and other global financial institutions are not merely passive holders, they are perceived as strategic participants in a broader digital asset ecosystem. The implication is that XRP is now functioning as a reserve asset, integrated into long-term treasury planning and institutional portfolio strategy. Unlike traditional investment assets that may be liquidated for short-term gains, XRP's allocation to these entities signals a commitment to hold, secure, and leverage the asset as part of a comprehensive digital finance strategy. The market interprets this as a tacit endorsement of XRP's long-term utility, a validation from some of the most sophisticated financial actors in the world. Psychologically, the removal of escrow overhang eliminates a persistent source of uncertainty. For retail investors, the constant speculation over monthly supply has historically introduced anxiety and short-term volatility. With the final 10 billion XRP confirmed as institutional reserves, the market can focus on adoption, utility, and broader macroeconomic factors rather than supply fears. Analysts predict that the scarcity effect will amplify demand pressure, as investors recognize that newly circulating XRP is now overwhelmingly controlled by entities unlikely to sell into short-term market swings. The combination of finite supply, institutional backing, and long-term strategic holding creates a perfect storm for upward price momentum, with market narratives shifting from speculative volatility to structural scarcity. So the timing of the release, it really contributes to the narrative by coordinating the announcement with market conditions that are, favorable for adoption. Ripple and its institutional partners are able to maximize the psychological and financial impact. The story of escrow cessation is now well intertwined with the broader narrative of XRP as a mature institutional-grade asset. Market commentators emphasize that supply shocks of this magnitude, 10 billion XRP entering locked institutional reserves, are rare and historically significant. Such events not only influence short-term price movements but also reshape market perception for years, redefining investor expectations, risk models, and strategic planning. Institutional behavior following the escrow release is already being scrutinized. While the wallets are known, the exact strategies and timelines for deployment remain confidential, adding a layer of intrigue and anticipation. Analysts suggest that even if institutions hold quietly, the mere presence of such a concentrated supply exerts a structural influence over market dynamics. Liquidity is effectively constrained, and the potential for upward price pressure increases with every passing trading session. The escrow cessation transforms XRP from a liquid, widely held crypto into a strategically allocated, partially illiquid digital reserve, reinforcing its narrative as a long-term financial instrument rather than a speculative commodity. The broader implications for the crypto ecosystem are equally profound. XRP's transformation into an institutionally backed reserve asset challenges traditional narratives around decentralization, utility, and market control. Critics who previously cited centralized escrow as a weakness are now forced to acknowledge the stability, strategic foresight, and market discipline inherent in the decision. Retail and institutional investors alike recalibrate their models, acknowledging that supply certainty combined with institutional trust creates a foundation for sustainable growth. The escrow conclusion marks a critical turning point in XRP's market evolution, signaling a new era in which scarcity, credibility, and strategic reserve allocation drive value. Media coverage amplifies the story, framing the escrow cessation as a watershed moment for cryptocurrency markets. Headlines proclaim, "Ripple ends escrow forever," and 10 billion XRP secured by institutions, signaling a structural shift in how supply is perceived. Analysts note that psychological effects on markets are immediate. Confidence grows, volatility shifts from negative uncertainty to scarcity-driven momentum, and narratives of institutional validation dominate trading discourse. The combination of finite supply, strategic allocation, and prominent institutional involvement creates a unique financial ecosystem in which XRP is no longer just a digital asset, but a long-term institutionally recognized reserve instrument. In conclusion, the final escrow release is not merely a technical event, it is a structural transformation of the XRP market. Supply shock is now a certainty. The remaining 10 billion XRP securely distributed to major institutional addresses removes the largest variable of uncertainty in the market. The overhang of monthly releases is gone, replaced by strategic institutional lockup that positions XRP as a long-term reserve, scarcity-driven asset. Market